Is equity mutual fund safe? This is the common question from many new investors. Is an equity mutual fund safe? And many people hear the word mutual fund and immediately think their money is fully protected, like the fixed deposit. But it does not work that way. So in this video, we will talk about equity mutual fund and really check if it is safe. And I will also try to explain everything you need to know about the equity mutual fund. So if you are a complete beginner trying to start investing in mutual fund, this video will give you the confidence you need to get started. And if you're a new viewer, please don't forget to hit that subscribe button, also hit the like button and join this community. You're welcome. So let's talk about the equity mutual fund. What do we mean by safety? Before we judge if an equity mutual fund is safe or risky, we need to understand what the word safe in this context really means in investing. Most beginners usually want answers to two questions. And one of the question is, will their capital be protected? Will their money, will that capital be protected? And two, will their return be steady? So protection and steady return on investment is the two things many people look at before investing. And your capital is the original amount you invested. Your returns are the profits your investment earns over time. So if your priority is to protect your capital from dropping in value, or if you want steady returns on your investment every year, every month, or every quarter, then you are looking for safety. Equity mutual fund do not behave like that. So let me explain why. For a complete beginner, what exactly is a mutual fund? It is a large pool of money where many people contribute small amounts. A professional called fund manager handles this money on behalf of everyone. And the fund manager studies the economy, check company performance, follow the stock market, and decides where to invest that money for the best results. So instead of you buying assets one by one yourself, the funds buys many investments at once. This gives you something called diversification. Diversification means spreading your money across different investments so that if one area performs badly, others can help reduce the impact. So what makes an equity mutual funds different? There are different types of mutual funds. We have the money market fund, the MMF money market fund, we have the bond fund, we have the balanced fund, we have the conservative fund, and a whole lot of fund in the mutual funds. And equity mutual funds focus on stocks. So that means every fund invested on the equity mutual funds buys stocks or ownership shares of companies. These companies that are listed on the stock market. So if the fund invests in, let's say, MTN, invest in, let's say, Dangote Sugar, or invest in any companies at all, you indirectly own small parts of those companies through the fund. Equity mutual funds usually invest between 60 to about 100% of the fund in stocks. And because stocks move up and down, equity funds also move up and down. So now that you know what an equity fund invests in, the bigger question here is equity fund safe? One, your capital is not guaranteed. Stocks rise and fall based on companies' earnings, government policies, interest rates, and investors' confidence. So if the stock market falls, the value of your mutual fund can also fall. This does not mean you have lost money permanently. It simply means the value is lower at the point in time. Now, an example is this. Let's say you buy into an equity fund and you spend a total of 100,000 naira to buy the fund. So let's say you have made some profits and this your 100,000 has become 120,000 naira. Then suddenly something happened on the stock market and you lose, let's say you're now at negative 10%. So that means this your 120,000 naira, what your capital has become because you made some profit, we now reduce 10%. And now you have minus 12,000 naira here. You may be having just about 108,000 naira in your balance. If another month you lost another 10%, that is how your capital and your interest, whatever you have accrued, will be losing in value. Now, it is vice versa. If the stock market is going up and the fund is also going up, you are going to make more profits. And two, returns are not steady. Some years, the stock market performs very well. During those periods, equity funds can begin to go up and you can get high returns and sometimes even higher than fixed income. In fact, most equity fund gives a better returns. But other years, the market can drop. And when that happens, equity funds can give lower returns or negative returns. It is not a stable or predictable investment in the short term because the interest is not stable. You can actually see how much the interest, the yield is increasing or decreasing every day from your fund managers platforms. So today you might see plus 2%, tomorrow you might see minus 2% or minus 1%, and next tomorrow again you might see plus 5%. So the interest is not stable. That is why returns are not steady on equity mutual funds. Okay, now why do people still invest? If returns are not guaranteed and returns are not stable, why do people still invest? Even when there are ups and downs, equity mutual funds remain one of the smartest long-term investment tools. Over long period, stocks have historically outperformed fixed deposits, treasury bills, and even most bonds. This is important because of something called inflation. Inflation is the rate at which prices increases. When inflation rises, the value of your money reduces. And if your money does not grow faster than inflation, you are actually losing value over time. Fixed income investments are stable, but many times they struggle to keep up with inflation. Now imagine on a fixed income, maybe you are getting 12%. Even though this 12% is a fixed yield, no matter what happens in the market, you are still getting your 12%. But still, this 12% cannot keep up with the inflation. If inflation is 20% and you are getting 10%, you are losing 8% every year. So equity have solved that problem because on the other hand, it has the potential to grow much faster, helping you build wealth in the long run. Who should invest in equity fund? You should consider this type of fund if you want to invest for long term, and let's say 3 or more years. It is ideal if you want wealth growth. If you want your money to grow, equity fund is good for wealth growth. And also, 3, if you are comfortable with the ups and downs, of the market, then equity fund might be a good choice. And 4, if you don't need the money, if you don't need it urgently, you can invest it in an equity fund. And also, if you want to beat inflation, also think of investing in equity fund. When you give your investment enough time, the short-term fluctuation become less scary because over time the market usually recovers. The market usually go and reward patient investors. Who should avoid equity fund? Avoid equity mutual fund if you need your money urgently. If you need your money as soon as possible, maybe in 1 year, it's not advisable to put it in an equity fund. And two, if you are the type that panic when you lose your investment, don't invest in equity fund because there are many investors that panic when their investment is dropping even a little. So if you find yourself in a category of people who will panic when your investment is dropping, don't invest in equity mutual funds. And three, if you want fixed income, avoid equity mutual fund. Let's say you want fixed income like the 12% and you want it just fixed. Don't invest in it because this does not give a fixed income. It can be up today and be down tomorrow. Now, another set of people that should avoid equity fund. If you prefer stable and predictable return, avoid equity mutual fund because it is not stable and it is not predictable. And another set of people that should avoid equity fund is for people that are building emergency fund. Don't put your emergency fund in an equity mutual fund because when you need your money today and the value has gone down, it will not make a good sense for you to withdraw it at a loss. Equity funds are not built for short-term goals. They are meant for long-term goals. Now, let me quickly explain this in a more simple language, especially for beginners. You see, equity mutual funds go up and down. Today, you might be making some losses, and tomorrow you might make a gain that will even beat that losses. So today you might have -1%, and tomorrow you might have +5%. It is not stable, even though over time, equity mutual funds has given the best return on investment. If you check the mutual fund in Nigeria, check the Nigeria Equity Fund has done about 40-50% return on investment, while other fixed income, even the popular money market fund has given about 17%. But equity mutual fund has been performing. But that does not mean it will keep on being like that. There are some times where you are making losses, where the losses is eating into your capital. If you know you cannot hold on to your investment during that period of losses, avoid equity mutual fund. Now, let's talk about the safer alternative, especially for beginners. If safety is your priority, I want you to consider this instead. And one is the MMF, which is the money market fund. The money market fund invests in treasury bills and short-term instruments. They are very stable and ideal for short-term goals. You can also do the bond fund. The bond fund is also a stable yield way of investing. It invests in government and corporate bonds that offer more predictable returns. Even though these options do not grow as fast as equity mutual funds, but they help protect your capital. So equity mutual fund carries a risk, and the risk is called the market risk. Market risk is the chance that the value of your investment can drop due to change in the stock market. And this risk is normal. It is the price you pay for higher long-term income. And to reduce this risk even further, investors use a method called the dollar cost average, which simply means DCA. So what does DCA means? It means to reduce your risk even further, you invest small amounts regularly. For example, you invest monthly. So instead of putting in a big amount at once, when you invest consistently, you buy at both high and low prices. You can use this method when you are even trading directly on the stock market. The dollar cost averaging, you are buying at when it is cheap, you buy, when it is high, you buy. And this helps you balance your overall costs and reduce the effect of market swings. So equity mutual funds are not safe for short-term capital protection, but they are one of the smartest ways to grow wealth over many years. They reward patience, consistency, and a long-term thinking. Now, I hope you know the best mutual funds that fit into your goal. Is it the equity fund? Is it the money market fund? Is it the bond fund? Thank you again for watching this video today, and I see you in the next video.